like anything else that's been ETFified, it's all about democratizing access to a space that's harder to reach typically. So, there's a lot of friction involved with placing bets traditionally.
All right, joining me will be Chris Marengo, Co-Chief Investment Officer of Value at Gabelli Funds, who back in January, they launched the Gabelli Opportunities in Live and Sports ETF. The ticker symbol is GOLS, GOLS, which this pretty much holds exactly what you think it does. This invests in companies involved in live media and entertainment and sports. So, for example, it owns the Atlanta Braves holding company. Madison Square Garden Sports is in there. Rogers Communications is a holding, which they own the Toronto Blue Jays and Raptors and Maple Leafs. Manchester United is another holding. You get the idea. This ETF is seeking to offer exposure to actually many of the things that I enjoy in sports and concerts and live experiences. So I'm really looking forward to this conversation because we'll obviously spotlight that ETF, but we are going to dive much deeper into the world of sports and live entertainment and the actual investment case here, which I would say there's clearly demand for sports and live entertainment, but that doesn't necessarily mean these are great investments. And so I'll have Chris lay out the overall opportunity here. So he'll join me a bit later. To start this week, I'll be joined by Kirsten Chang, Senior Industry Analyst at VettaFi. And we are going to discuss something that I have been chomping at the bit to get into, which are these recent filings for prediction market ETFs. So we saw a slew of these filings a couple of weeks ago from Roundhill, Bitwise, and GraniteShares. And no surprise, these have generated a lot of debate, both inside and outside the industry. And so Kirsten and I will explain these filings for you. And we're going to have a conversation around the rapidly blurring lines between gambling and investing. I have quite a few thoughts on this. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let's now chat with VettaFi's Kirsten Chang, who will be in Vegas for the Exchange Conference in a couple of weeks. And Kirsten, I'm not sure if you're a gambler at all, but you're actually going to get to talk gambling right now with these prediction market ETFs, or maybe these are hedging tools. That's what we're going to get into. But how have you been? It's so great having you back on the podcast.
Yeah, Nate the Great. Always good to be back with you. I'm not a big gambler myself, but my husband is he's big on sports betting. So I have been in this world for a little bit, talking spreads, over, under, all that good stuff. But very excited to see you in Vegas. I've been great just trying to keep a tiny human alive for the past 4 months. So, good to be back in the fray.
Yes, it is wonderful to have you back here. And let's dive into this. So as I mentioned a couple of weeks ago, we did see this flurry of filings for prediction market ETF. So I believe Roundhill filed first, and then they were quickly followed by Bitwise and GraniteShares. And we'll get into the specific filings here in a moment. But as you know, I always like to cover the basics, which I know you have kindly agreed to do this week, which I appreciate. And so let's start there. For people unfamiliar, maybe first explain what a prediction market is. And perhaps you can highlight a few of the big players here and then explain what event contracts are, which is what these ETFs would actually hold.
Right. So these prediction markets are essentially platforms. They're basically exchanges where people can buy and sell shares, but instead of buying and selling shares of stock or a company, you're buying shares of an event contract that's based on some future outcome. So it can be anything like sports, elections, economic data. Is Jay Powell going to sneeze during his speech, or even the weather? Now, these are all or nothing contracts. They're binary. So these shares are usually priced between $1 and $1, or excuse me, $0 and $1. Prices at the time will reflect the aggregated probability of an event occurring. So the Chiefs have a 60% chance of winning the Super Bowl. They're priced at 60 cents per share. So if the event occurs, the contract pays out $1. Otherwise, it's worthless. It goes to zero. Your principal, you get nothing. So an event contract, that's a short-term financial derivative that allows traders to kind of speculate on whatever outcome they want. And so if prediction markets are the where, the event contracts are the what. So it all really boils down to this wisdom of the crowd mentality, the idea that you can pull together more accurate predictions by looking at the collective rather than, turning to an individual expert. And so the big players here are Kalshi and Polymarket. They control like 90% of the entire global predictions pie. And these are both decentralized exchanges that allow people to bet on these events. I think Kalshi has done a lot more with sports, but Polymarket has been mainly crypto and politics and aliens. Are aliens real is an actual bet you can place on Polymarket right now. But both of these are regulated by the CFTC, and then they use that binary yes or no share structure.
Okay. And I would say these prediction markets have really risen in prominence over the past year or two, probably going back to the 2024 election. I remember tracking all of the presidential election odds on Polymarket, and it seemed like every major media outlet was doing the same. So that seemed like a big catalyst in sort of bringing these mainstream. And then I think we've also seen the regulatory backdrop evolve. As a matter of fact, just a few weeks ago, the CFTC, the Commodity Futures Trading Commission, they filed a brief saying that they have exclusive jurisdiction over event contracts because there's been a lot of back and forth over whether these should be regulated by the CFTC or if this is all basically gambling that should fall under state gaming laws. And so, actually, maybe offer a little bit of color on all of that, just the rise of these platforms and then sort of the evolving regulatory backdrop.
Yeah, it's really interesting. It's exploded. As you mentioned, the entire industry is $40 billion in trading volume. That's up from less than $10 billion 2 years ago. It's a lot of trading volume under. I think it was monthly trading volume going from under $100 million in early 2024 around that election to over $13 billion by late 2025. So that's a huge increase in just 2 years. But the Federal Reserve just published a study comparing Kalshi markets and prediction markets to more traditional survey and market-based forecasts. And their findings were actually pretty positive in favor of Kalshi. They concluded that these are valuable tools for both researchers and policymakers. So I do think there's something to this when you're able to sift through the noise. The wisdom of the crowds can actually sometimes give off some important signals. But on the regulatory side of things, the legal jurisdiction is still really murky, right? You'd think with all the sports betting rules out there, the states should have a say on these prediction markets in the same jurisdictions. And we are seeing some lawsuits happening. Kalshi is getting sued by a few states, but the platforms are regulated by the CFTC. And then obviously gambling casinos regulated at the state level. So there's a lot of sort of detangling of regulatory overlap to figure out. And it gets very murky.
Well, and I think a good example of that is just this week. I saw yesterday DraftKings, which of course offers sports betting, they're getting into the prediction market business. And then you know who else filed with the SEC yesterday to offer prediction markets? NASDAQ. So they want to list these binary options on the NASDAQ 100 index, and I think they're micro index as well. But I think that shows you sort of this tug of war here. Here you have a major exchange in NASDAQ who wants to get in this business, and then a major sports gambling outlet. And I think that kind of tells you a little bit about the, again, kind of this tug of war on the regulatory side, which we can talk more about that in a moment. But let's get into the ETF filings that we saw a couple of weeks ago. And I always say if something can be put into an ETF, issuers will find a way, right? Which I like that. I love the innovation in the ETF space. I've always been a proponent of the innovation. Ultimately, investors have to do, their homework. But do you want to walk through these filings at a high level? Maybe explain the types of event contracts that these would hold, and just give us a flavor for a few of the specific ETFs.
Yeah, so Roundhill filed for 6 of these ETFs. And now remember, Roundhill also has the sports betting ETF, ticker BETS. They launched that during COVID in 2020, and that hit $1 billion at 1.4 years, though it's gone down from there. But they've been in this online gambling arena for quite some time. But these new ETFs, they deal with who wins the White House, who wins the House and the Senate. They're tracking market prices from the platforms like Kalshi and Polymarket that are out there. So for instance, if you were to buy the Democratic President ETF, let's say it's at 50 cents and that's who won the White House, the contract would settle at $1. That's the payoff you'd get. And typically we see these prices kind of converge around the actual odds closer and closer to election day before they get to $1. And the funds also exit positions early before official election certification. So if the market implies kind of a greater than 99.5%, I think, certainty for 5 days in a row, then those funds would liquidate and roll proceeds into contracts for the next election cycle. So that's kind of how they would work.
Well, let me ask you this. Do you have any concerns over the actual mechanics of how these ETFs work? You just walked through the basics, but for example, What if these ETFs are wildly popular? Do you think there will be enough underlying liquidity in these event contracts? Will authorized participants and market makers, will they be able to hedge properly? Like those sorts of things. Do you see any concerns there?
Yeah, I think you've hit on the exact plumbing problems that are keeping regulators up at night right now. First off, that early exit mechanism I just mentioned, that creates timing risks because if the market incorrectly assumes an outcome, with that 99% certainty, the fund would exit its positions in error. And then you might get a legal battle or a recount that changes the winner that could leave shareholders kind of locked out of the reverse payout. So, and then to your point, thinly traded markets are definitely a concern. You want the liquidity to be deep enough to support the scale. These event contracts, they're often traded in a lot shallower markets compared to your typical ETF holdings. So that could definitely throw off their creation redemption process. And, the risk is that during periods of stress, APs might step back, which could lead to price dislocations, wider spreads, higher entry fees, all that. These APs, they could obviously find creative ways to kind of lay off their risks, counterparties, correlated bets, but none of these are perfect hedges at the end of the day. And I think another fear of mine is that these funds are kind of subject to manipulation or potentially insider trading, right? We saw what happened with what some people are concerned about with prediction markets in Iran this week. That's brought a lot of kind of heat against prediction markets overall. So there's still a lot to sift through and a lot for regulators to consider.
Yeah, it's a great point. It's like, how do you surveil these markets properly? And insider trading is a big issue in prediction markets. Now, I think you could make the case that insider trading has been involved, unfortunately, in markets since the dawn of time. And now with prediction markets, that information is just rapidly assimilated into the prices of these event contracts. Maybe that's a good thing, and that's why these event contracts seem to do a better job of predicting where things are going to go than, say, the traditional mainstream media. But from an investment standpoint, clearly that's an issue if you have insider trading or manipulation. Um, if we come back to, I guess, what I would call the positive side, assuming there are no plumbing issues with these ETFs and they function properly, and just putting aside any investment merit or gambling merit, if you want to call it that, what problem does the ETF wrapper solve here? Like, why wrap event contracts into an ETF to begin with?
Yeah, well, like anything else that's been ETFified, it's all about democratizing access to a space that's harder to reach typically. So, there's a lot of friction involved with placing bets traditionally. You typically have to open an account. You might have to manage multiple positions, navigate different interfaces, and also use crypto in some cases to place bets on Polymarket because they use the blockchain. But with an ETF, you don't need any of that. You don't have to learn how to bridge crypto to Polygon. You can just search for the ticker symbol in your Fidelity account and click buy. So it's all about bridging those kind of Wild West markets, with the umbrella of traditional regulated finance. And so that could open up institutional access to gambling and so on and so forth. And it's always about making it a more seamless experience, right? Same thing that gold ETFs did for the space 20 years ago, where you no longer had to own physical gold. Same thing with crypto ETFs, where you don't need a fancy crypto wallet anymore. And same thing private credit ETFs are trying to do to the space. It's all about disrupting it, blurring the lines, and in some cases, just getting rid of the lines completely.
Yeah, you hit on the three areas that I would actually point to as well in terms of opening up access: and gold, crypto, and private markets. And we can debate whether or not that's a good or bad thing for investors, but the fact is the ETF wrapper, has opened up that access. And it's made it easier for good or bad to allow investors to access these areas, especially more traditional investors who maybe aren't comfortable navigating those underlying markets. Okay, so let's get to the real question here, which is, do you think there is actually a market for these? Are there enough institutional investors or advisors who may view these as hedging tools? Or are there enough retail investors who would like to gamble on the outcome of elections who aren't already doing this on prediction market platforms themselves? Like, what do you think demand might look like?
Yeah, honestly, at this point, I'm not convinced yet. I don't see advisors looking into these as serious portfolio allocations anytime soon. These are not strategic holdings that add any kind of meaningful diversification. They're just a way to express an opinion with your wallet, right? So you look at a stock that represents ownership in a company that generates cash flow. These ETFs, they don't have any dividends, no intrinsic value. It's just the binary outcome of an election. We are looking at Polymarket already seeing a lot in trading volume, $300 million in overall trading volume, and we're just 2 years away from the election. So that is kind of the total addressable market I think these ETFs are targeting. And you could theoretically use these ETFs to kind of hedge against industries. Maybe if you know a certain administration will be more pro big oil or pro solar, for instance, but it's really not a mark to market hedge. It's a binary hedge. So I think the market itself will always give you better hedges. And I don't see the demand there quite yet.
Well, the one thing I wonder though is, we're talking about ETFs based on election outcomes here. Excuse me. Really, there's no amount of different ETFs that could roll out, right? Because these prediction markets, as you were mentioning earlier, they allow you to bet on pretty much anything. And so you wonder, like, where does this end? You could have hundreds or thousands of different prediction market ETFs roll out based on outcomes of anything. Could we see sports betting in an ETF, for example? Could you have leverage prediction market ETFs? Will you have the options, ecosystem pop up around these? I mean, you could have option outcome prediction market ETFs. It just seems like there's really no end to, what you could see here. Which I guess let's get into the bigger picture story here. And, I'll tell you, Kirsten, when these filings came out, and you may have seen this, I tweeted something to the effect of everything is basically DraftKings now, right? It all just seems like gambling. And we do continue to see this further gamification of finance. I'm curious, how do you feel about all this? Do you see any pros? Is it all cons? What's your bigger picture take? Because to me, it just seems like there is no line between gambling and investing anymore.
Yeah, I agree. In many ways, it is a brilliant move to bypass the traditional systems betting institutions have put in place. These are legitimate, well-respected ETF issuers, GraniteShares, Bitwise, Roundhill, with smart people behind them. Do I necessarily agree that just because it can be done, it should be done? No, I'm a much bigger advocate for long-term investing and placing bets the good old-fashioned way with fundamental analysis. On parts of the economy that have real value. I think a lot of critics out there would say we're just giving gambling a nicer suit and a formal ticker. And you and I know we're all in favor of financial innovation, but I think we can agree not all innovation necessarily benefits the greater good. Now, in terms of gamification of investing, I do like the aspect that we are broadening the demographic, the appeal to younger, more retail audiences. But it's you just got to draw the line and you got to be careful. And I think it's up to the regulators to kind of put that first line of defense. But then, of course, it's the advisors and the analysts out there. The onus is on us to really educate people.
Yeah, I go back and forth on this a lot, which you probably have gathered because, as I mentioned earlier, clearly I'm a proponent of ETF innovation. And, I love the fact that the wrapper has made pretty much any asset class accessible to end investors. However, if I think about prediction markets, first let's start with I don't want to get too stand on the pulpit here, but there are real negative consequences from gambling addictions in our society. And, I'm not saying anything should be illegal, but gambling has destroyed people's lives. And if you continue to make that easier and easier for people to gamble on anything, I do worry about that a little bit. On the other hand, and you were alluding to this earlier, when you look at these prediction markets, and I think this was in the Fed paper you mentioned too. I read that a few weeks ago as well, where they said, these markets do provide, really high frequency, like continuously updated, valuable data to researchers and Polymarkets. It's real time. I would argue that these prediction markets have done a better job for the most part than even, as I mentioned before, traditional media on where things are going to head. And so it can be very, high signal information that's out there. So I think that's good. But then I'll come back to the other side and talk about insider trading, which we hit on before. We know that can be an issue, but I can also see how insider trading, as I mentioned, is assimilated into these markets very quickly, and so maybe that gives you that higher signal, information. I don't know. I go back and forth on this. I don't have. I will never fault ETF issuers for pursuing innovation, and at the end of the day, I do think it's incumbent upon end investors to do their homework and know what they own. But we are making it very easy for people to gamble on just about everything, and I do have some concerns around that.
Yeah, I'm with you. I think my instinct is just saying, the wrapper makes it a little too easy for the average retail investor to misunderstand that risk and kind of play too loosely with these high stakes bets because it's just so easy to do with the click of a button.
So, with all of the areas we've covered here, I guess I'll just ask you very simply: do you expect the SEC to approve these?
I'd say chances are very low, but not zero. The SEC historically, if you look, they've been very cautious about approving funds, anything that resembles gambling, anything that offers an extreme binary risk profile. So I don't think they're eager to approve anything that could give sort of a black eye to the financial system if something goes wrong. But the current administration has certainly been a lot friendlier toward higher risk, more speculative parts of the market, and Trump himself has shown support for expanding gambling access. But I just think there are a lot of hurdles to clear. The risk disclosures need to be made extremely clear. It's not clear to me that even if the SEC does approve them, that the state government bans wouldn't prevent these ETFs from being traded anyway. So there's a lot of just detangling again in the regulatory world that needs to happen first. But if I'd have to put a number, maybe 10, 20%.
Well, I just think this is going to be a fascinating story to follow here. Maybe not quite as fascinating as I found the spot Bitcoin ETFs, but some of the issues we've hit on, the liquidity of the underlying event contracts. We talked about that. As you mentioned, there's still this tug of war between whether these fall under the CFTC or these fall under state gambling laws. Some of the plumbing issues that you touched on, and just in terms of APs and market makers and, what all that looks like. There are some real, surveillance, right? Can you surveil these markets properly? There are plenty of items out there that I think the SEC is going to have to work through. So I'll be fascinated to follow this. Real quick, before I let you go, completely different topic. As I mentioned earlier, I will be seeing you at Exchange in Las Vegas in a couple of weeks. And besides me probably trying to get you to further discuss prediction market ETFs while we're there, I'll probably have, that'll be me at the bar with a beer in my hand trying to get you to talk prediction market ETFs. Is there anything else on your agenda? I know you're hosting the ETF due diligence session on that Sunday, right? Which I'll be participating in.
That's right, I am. I'm hosting the ETF study hall with you and a bunch of other ETF aficionados. Of course, Eric Balchunas, Elizabeth Kashner from FactSet, Todd Sohn, our good friend from Strategas. So we're going to go around the horn, kind of get your guys' take on the ETF landscape today. 5,000 products out there, copycat every day. I think it's important to really help our audience sift through the noise. But just 2 weeks away, we've already got over 1,200 registrants and counting. And speaking of Roundhill, they'll be sponsoring a puppy lounge this year. I was told to promote that. It's an on-site rescue. Puppies are available for stress relief. So that's part of that wellness component. But in terms of panels, Todd Rosenbluth's going to sit down with State Street to talk more about updates on PRIV, that private credit ETF that's getting a lot of attention. I'll be introducing our old friends Dom Chu, Bob Bassani from CNBC for their panels. And I'll be doing a couple panels on fixed income myself, talking structured credit with Reckoner and Obra Capital. A lot of CLOs are obviously entering the mainstream. We're going to get into that. And the one I'm really excited about is Bob Bassani's fireside chat with Kara Swisher. She's going to have plenty to say about AI and prediction markets, everything we've been talking about. You take a semi-retired Bob, you put him next to an irreverent tech nerd like Kara, and you've got gold on your hands. It should be a great conversation. So if you haven't registered yet, just head on over to exchange.etf.com and we'll see you in Vegas.
Well, you are going to be extremely busy, it sounds like, while you're there. I always feel like when I go to these things, it's a blur for me. I think your agenda seems more packed than mine, but I look forward to seeing you there. And seriously, thank you for diving into the prediction markets and event contracts this week with the ETF filings. Greatly appreciate that. And thank you for joining me.
Of course. Thanks for having me on, Nate. Take care.
That was Kirsten Chang, Senior Industry Analyst at VettaFi.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Chris Marengi, Co-Chief Investment Officer of Value at Gabelli Funds, who currently offers 8 ETFs over $150 million in assets. And of course, Gabelli is under Gamco Investors. That includes Gabelli Funds and Gamco Asset Management. Altogether, we're talking about $35 billion in assets under management. But Chris is the portfolio manager on the recently launched Gabelli Opportunities in Live and Sports ETF. The ticker symbol is GOLS, GOLS. This just launched in January, and Chris is now joining me from New York. Chris, it is a pleasure. Welcome to the podcast.
Great to be here. Thank you for having me.
Okay, so I have to tell you, I'm greatly looking forward to this conversation because I am an avid consumer of both live and sports entertainment, probably much to my wife's chagrin, at least on the sports side. She definitely loves going to concerts and all of those sorts of things. But before we get into all that to start, maybe give us the quick backstory on this ETF, why Gabelli decided to bring this to market.
Yeah, so we have a tremendous amount of accumulated compounded knowledge in the media industry. Our founder, Mario Gabelli, pretty well known in that area. I started 20 plus years ago as an analyst covering that area, and a lot has changed in media. But one thing that hasn't changed is the consumer's appetite for live and sports. And so, we've been investing in things like the Atlanta Braves baseball club since that came public in 2016. Formula One, other names that we'll talk about for a long time in our mutual funds. And we thought now was a good time to kind of supercharge that, concentrate that in a product that was dedicated to those areas.
Okay, so why don't we do this? Why don't we have you first go through the ETF itself? You can explain the basic investment approach, the types of companies you're looking for, because this is actively managed. And then we can get into the investment case and sort of the potential longer term opportunities here. So just walk us through what this ETF holds and how you're approaching the day-to-day management of this.
Yeah, so you mentioned it. This, I would emphasize, is an actively managed ETF. We have been in the actively managed ETF space for a number of years under different wrappers. This is fully transparent, but we are underpinned by our private market with a catalyst approach. That is, briefly, every publicly traded stock has a private market value, which we estimate using a number of different methodologies, the most important being actual transaction comps, what an informed buyer would pay for the entirety of the business. And then we compare that to the public market value, which is the stock price. Look for margin of safety and look for one or more events that will drive that public price closer to the private price. And so, we've got a list of securities that are primarily sports franchises and leagues and promoters. We could talk about those. There are about 30 of those public in the world. I think that is a number that is increasing. And then other members of the ecosystem around sports, including owners of venues, media partners, et cetera. So we've got a pretty big menu to choose from, and haven't had much trouble getting invested in the 2 months we've been at it, and pleased with where we are.
Well, let's talk more about some of those holdings. If I look at the top holdings in the ETF right now, I do see companies like Liberty Media, which of course they own stakes in various media and sports properties like F1, which you mentioned earlier. I see the Atlanta Braves holding company, Madison Square Garden Sports, Manchester United, Rogers Communication, which they own the Blue Jays and Raptors and Maple Leafs. So talk more about the overall investment universe here, because obviously there are a lot of sports franchises and entertainment companies that aren't publicly investable, right? Many are privately held. And so I'm just curious, what does the overall opportunity set look like here? And do you feel constrained at all because there are so many companies that are still privately held?
Yeah, so the pitch here really is, and pun intended, is invest like the ultra wealthy. So obviously sports ownership has been dominated for decades by the ultra wealthy who buy sports teams for a bunch of different reasons. Sometimes that's ego, which is not necessarily a bad thing, but these are actually in many ways good businesses that have characteristics that we look for in non-sports assets. So recurring and predictable revenue, mostly through ticket subscriptions and long-term media contracts, predictable costs, and low capital intensity. And we think over time, there'll be more sports assets that become public, in part because some of the rule changes in what we call the big four leagues in the US. That's the NFL, NBA, baseball and the NHL that have allowed more institutional ownership. So again, private ownership via institutions and big private equity firms, for example, dedicated to this space. But they're going to want exits at some point. They're not forever owners mostly of these businesses, and certainly one way to go to exit an investment is to go public. So, we're going to see, I think, spinoffs of, you mentioned Rogers Communications. They have discussed actually spinning off their sports assets, and probably some go publics of existing private assets. So the list of investable companies we think will get longer for us.
Yeah, and to your point on the rule changes across the big four sports leagues in the U.S., what you're saying is they do now allow private equity and other institutional investors to participate in the growth occurring here. And so if they do want exits at some point, obviously the public markets are where they will go. And so that'll increase the opportunity set available to something like, or an ETF like yours. Is it that simple?
Yeah, I think that's right. And one of the other benefits of those private transactions, for example, a minority stake sold in the New York Giants, our local football team here, at equivalent of a $10.25 billion value, we can use those as good benchmarks for what these stakes are worth. And there have been a lot of these stake sales. If you've just been reading the newspaper, a lot of deals happening in this space because these we think are very good storers of value and good businesses. So, we're trying to benefit from that.
In terms of the other types of holdings that you may have in this ETF, and again, I was looking through the list. Hopefully I didn't miss anything, but I was curious, what about a venue like the Sphere in Las Vegas, which I saw you two there, was an amazing experience. I think COSM, I believe is what it's called, where they show these live sporting events and these fully immersive experiences. I don't think they're publicly traded yet, but my question is, could you envision owning companies like that at some point?
We love those companies and do own them. So we own, for example, Madison Square Garden Entertainment, which is in that Dolan family of sports companies. Of course, Madison Square Garden Sports, which owns the Knicks and the Rangers. Madison Square Garden Entertainment is a separate company that owns the building, Madison Square Garden itself, which of course is home to the Knicks and Rangers and lots of concerts. And then we do own the Sphere. There are some sporting events at the Sphere, boxing matches, e-gaming, but primarily a venue for concerts and other sorts of live entertainment. I also saw U2 there. Amazing experience. If you're in Vegas, you should definitely stop by. They're building more of those. COSM is very interesting, as you mentioned, not public, but an interesting example of how technology can actually benefit a number of sports franchises. So, the Garden, for example, has 19,000 seats and a much more limited number of seats around the baseline. You can pay to go watch a game at a venue like COSM and basically be sitting virtually at a baseline. And so there is actually a company that we own in Japan called DNA that is building a very similar venue in Japan. They also own a baseball team there. So we think that's a huge benefit, a huge tailwind for teams over the next several decades.
Okay, what about gambling companies? So I didn't see any of those in your holdings. Again, hopefully I didn't miss any, but I would say obviously these are heavily tied to sports. You have DraftKings, Flutter, which owns FanDuel, et cetera. There are a number of them out there. Could you see goals owning those types of companies at some point?
So an interesting and controversial question. So today we don't own any standalone casinos. We do own some companies, a couple of companies that touch gaming, those being Churchill Downs, which of course owns the Kentucky Derby, one of the largest live sporting events in the world each year. And of course they, make much of their money, not all of their money, but much of their money from gambling. And then Sport-tradar, which does a number of different things. They provide data to a number of those companies and the leagues themselves, tracking pitches and goals and things like that. Pretty interesting company, but we don't own at the moment DraftKings or FanDuel. I think the teams and leagues have benefited so far from the introduction of legalized gaming in gambling in sports. It's driven revenue, driven engagement in television, but there are certainly some downsides to those. And so we're that is a question mark. There are also, of course, as you discussed, some challenges, commercial challenges from the prediction markets companies. So something we're trying to figure out. And again, ultimately, we're trying to make value-based fundamental decisions in what we buy and sell in these portfolios.
All right. So I think we've done a good job of covering the ETF itself. Let's get into the overall investment case here. And I would tell you from my perspective, intuitively, this all makes sense, right? You only need to turn on the TV or go to some of these sporting venues. Everything's packed. The TV ratings are astronomical. Look at the TV ratings for the Super Bowl or even the U.S. men's Olympic hockey game, which we just saw. Or I would tell you, Chris, if you have daughters like me, I challenge you to try and go buy Taylor Swift tickets or Megan Maroney tickets. Like, good luck with that. There's clearly significant demand for live sports and entertainment. And so intuitively, this seems like a good place to invest. But I want you to paint the picture for us here. How do you like to describe a longer term investment thesis?
Yeah, I mean, that's exactly right. And I do have daughters and I've gone through that exercise before. And yes, we have seen for decades, actually, the demand for live entertainment and sports outpace demand for other consumer expenditures. And in fact, the Bureau of Labor Statistics tracks this, and inflation in that area has outpaced overall inflation. Again, not a surprise. We tried to buy any of these tickets recently. I think that secular trend has been supercharged by my kids looking at their phones and looking for some community elsewhere. I think also, COVID was a contributor to that. So that's not a secular trend that I think is going to let up anytime soon. But, that ultimately is one of the cases for owning the businesses that benefit from that. I think more broadly, as I mentioned earlier, these have proven to be great stores of value. So if you go back a dozen or so years and you aggregate the value of all the sports teams in the big four leagues, as estimated by a number of publications, that group as a whole has compounded at, call it a 15-16% rate, which is higher than even the S&P 500, which set a pretty high benchmark over the last decade. So, there's a question about whether sports assets are a different asset class or not. I think you can argue both sides of that, but I do think that they are different. They have some characteristics of gold and fine art because there is a little bit of an ego element to owning them. They're scarce, obviously, and they're not particularly correlated with the overall economy. So that's kind of how we see it in a broader portfolio.
This may be a really novice question, but do what I would call landmark events like we have coming up help the space overall? So as an example, we have the 2026 World Cup. I'm in Kansas City. It's actually one of the host sites, and so there's a lot of buzz around that. We have the 2028 Olympics in Los Angeles. Do those sorts of things and all of the advertising, and I think about the broadcasting, everything that goes into that, does that help lift the space? Is that a potential driver as well?
Absolutely. And I should mention, of course, that, and again, I'm a specialist in the media industry. The media industry, particularly the broadcast networks, are driven by news and sports. 7 of the 10 most watched programs in 2024 were related to sports. Most of those, just about all of those, I think, were actually the NFL. And if it hadn't been an election year, it would have been 10 out of 10. So certainly that helps. The FIFA World Cup in particular is interesting because even though soccer, as we call it, is the most popular sporting event in the world, it is much lower on the rung of priorities in the U.S. And we think that could change. And the presence of that World Cup in North America and the U.S. in particular, we think changes that. And there are a lot of actually public soccer teams, mostly in Europe, that are available to invest in. A number of those we think will probably uplist to the U.S. over time. Man U, of course, which you mentioned earlier, has done that already. So any uptick in soccer is probably incremental and would support the valuation of those companies.
To your point on broadcasting and media, it's amazing because you look and we have seen companies like Amazon and Apple and Netflix. They've all gotten way more involved in live sports programming. And if you look at the sums of money they're paying, I mean, we're talking about astronomical deals for media rights. They're obviously doing that because they see an opportunity there. Can you just talk a little bit more about the media side of the equation?
Yeah, it's interesting. Actually, one of the big pushbacks I get about investing in sports franchises as well, there's cord cutting. People aren't watching network television as much anymore. RSNs, regional sports networks, are kind of dying on the vine. What happens to that revenue stream for sports franchises? And for me, it's a pretty easy answer, which is that the pockets of money available at the companies you mentioned, Amazon, Netflix, Apple, others, are much deeper than what you saw amongst regional sports networks and local broadcasters. So those companies have stepped in. They're paying higher prices because this is such compelling content and such scarce content that drives subscriptions to streaming. So I'm pretty bullish on that media revenue line going forward.
You had mentioned demand coming out of the pandemic earlier, just for live sports and entertainment, sort of this desire among consumers to attend live concerts, and they want to be at live sporting events and other experiences. And I agree with you. I mean, there was clearly this pent-up demand coming out of the pandemic, but it hasn't let up at all. It just seems to be accelerating. Can you talk more about that? I mean, we've kind of been discussing that throughout this conversation, but this desire for live experiences, the appetite is insatiable.
Yeah, and it's true. I mean, originally, this was, people call these revenge trips, revenge concerts, whatever. As we came out of took off the masks and came out of our houses a few years ago. But yeah, you're right. It hasn't let up. We're going to have, one of the biggest years ever in concerts this year. One of the companies that we own is Live Nation, which is the number one concert promoter in the world. And artists themselves, as is well known, make most of their money from touring. This is very different than half a century ago when you dropped a record and you made your money from selling records. Or more specifically, the record companies made money from selling records. So the artists want to be out there. That's how they're filling their pockets. And so there's no shortage of supply. And so far, there's not been any shortage of demand. And again, think that continues and will be accentuated by, frankly, the evolution of AI, where, a lot of the Spotify and other distributors of music are going to be filled with AI content. You can't really create an AI concert.
Good point. Nor would we want that.
At least not yet.
Not yet. Okay, let me play devil's advocate here for just a moment, if you don't mind. I think we both agree. I think most people would agree that there's tremendous demand for sports and live entertainment. Talk more about valuations across this space. And the way that I would frame this is, obviously, just because there's demand, that doesn't necessarily mean these companies or teams are good places to invest. And you talked a little bit earlier just about your framework and managing the ETF, but I'd love to have you expand on how you think about valuations across this area.
Yeah, so these are, for the most part, especially in the live entertainment concert area, pretty fast growing businesses. They're growth companies. They're valued like growth companies in many cases. So sports teams are a little bit different. They tend not to have, and this is a bit unlike most of the companies that we invest in on the value side at our firm, they tend not to have a lot of cash flow, although that varies. Actually, the Atlanta Braves Baseball Club, for example, does actually generate some EBITDA and cash flow. But they're really managing the business to revenue growth and to popularity. So I guess just to take a real life example, one of our larger holdings is, as we mentioned earlier, the Atlanta Braves Baseball Club. They also have this really interesting real estate development attached to the Braves. It's called the Battery. If you're a baseball fan, it's a great place to watch a game and hang out for an afternoon. So there are 63 million shares of the Braves. The stock is just a little bit over $40 a share. There's about $700 million of net debt. So if you value the Battery at around $1 billion using kind of traditional real estate metrics, that means you're creating the Braves for just over $2 billion. And then if you look at what other transactions have taken place, including a minority stake sale in the Philadelphia Phillies for kind of 2.9 billion, that looks like a bargain. We think the team alone is worth in the mid $3 billion range. We put the stock in the mid 60s. So anyway, that's just an example of kind of how we see the value. When we look a little bit more like Warren Buffett than statistical value investors. So we can pay a high multiple for a business as long as the private market value is even higher.
Are there any off the beaten path metrics that you would look at that maybe would surprise people? Like, so for example, this is probably not the greatest example, but let's say the Atlanta Braves They have losing seasons 5 years in a row or something, and nobody's showing up at the park, and ticket sales are down. Nobody's watching them on TV. Is that something that would get your attention?
Yeah, but the interesting thing about that, we've had real life examples of that locally with the New York Knicks, who've had a struggle over the last decade. People still showed up for games, still bought gear, and obviously the Knicks are pretty hot. They have a chance to really contend this year. It hasn't moved the needle a whole lot. Obviously, it's better to make the playoffs because you've got more games and more revenue. But one of the things that we love about sports is that this is tribal. I mean, you're born a Knicks fan, born a Yankees fan like me. You're going to love them through thick and thin and show up in the games, pretty much no matter what happens. So, that's what makes it economically resilient and resilient to even what the record is.
All right, a few minutes left here. If we come back to the goals ETF, how should investors think about this in the context of a broader portfolio? Should they view this as a satellite, a thematic play, or how do you see this being used?
Yeah, so clearly this is a theme. It's, I think, a very good theme in terms of live and sports. But it does, as I mentioned earlier, represent what is a different asset class, like gold, like art, gold and not golds, but gold, like the metal, and art, that are sort of not necessarily correlated to what else is happening in the world. It's a store of value, and there are fewer of those as the value of the dollar comes into question for geopolitical reasons. So, we think it's a good complement to the rest of an equity or bond portfolio.
Are you seeing more traction here, or is this more geared towards retail investors? Is there interest among advisors, family offices, institutional investors, all the above?
Definitely all of the above. When we launched this or we conceived this, we thought this would be a great retail product. Obviously, lots of sports fans out there. It's in an ETF wrapper, which is easy to buy. Don't have to, have a lot of money to do it, and you can get involved in the ecosystem. It's young, so we're not widely available on platforms yet, but we definitely have a lot of interest from advisors. I would tell you one thing that has surprised me a bit is how many inbound calls I get from family offices. This is clearly an area that family offices are focused on. And if you're a smaller family office, it's a big ticket to pay to get into a 10% interest in the New York Giants, for example. But this is a way to kind of get involved, figure out what's going on, and so we've got some of those, and we welcome one and all.
Well, I'll tell you, I'm a little envious of your role. The fact that you get to talk about this every day and field those inbound calls, what a fun spot to be with everything going on here. Chris, congratulations on the launch of this ETF. I'm fascinated to watch this space moving forward. So we'll have to reconnect down the line. But thank you very much for joining me.
Great to be here. Thank you for having me.
That was Chris Marengo, Co-Chief Investment Officer of Value at Gabelli Funds. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I have two fantastic guests for you. I'll be joined by the one and only Rob Arnott, founder of Research Affiliates, and I'll also be joined by Michael Kohik, who is Director of Product Management at Van Eck. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.